morning. Thank you for joining Thompson Hine's weekly coffee chat series. My name is Owen Pinkerton. I'm a partner in Thompson Hine's investment management practice group. For any of you that tuned into last week's webinar and heard that Owen Wilson would be moderating this chat, I'm sorry to disappoint you, but while I'm no Owen Wilson, hopefully you will find this webinar useful. Joining me today is Aaron Hecht, Managing Director at JMP Securities, who follows cannabis companies, including the two REITs listed on NASDAQ and the New York Stock Exchange that have a cannabis focus. As the number of states that have legalized medicinal and/or recreational use of cannabis has increased, investor appetite in companies that are directly involved in cannabis operations or provide financing or services to such companies has also increased. At the SEC, the Division of Corporation Finance has declared a number of registration statements of so-called plant-touching companies effective, while the Division of Investment Management has taken an entirely different position for investment companies that seek exposure to cannabis companies. Today, we will explore the market for cannabis investments in general and discuss in much greater detail how the SEC has responded to the increase in investor demand for this market. If you have any questions or comments during today's program, we encourage you to join the discussion by using the Q&A box on your control panel. My colleague, Christina Nadasdy, will be monitoring that, and we will address your comments as we move through our discussion, and we'll try to leave some time at the end to answer these as well. We will follow up accordingly to any questions we don't get to during our time together today. So with all that being said, let's get started. And Christina, can you post the disclaimer for Aaron? There's a disclaimer we need to post regarding Aaron's coverage of the company, two of the companies that we're going to talk about today. Okay, so before we dive into specifics about how the SEC is treating issuers that have a cannabis focus, let's take a step back. The basic issue is that there's a fundamental conflict between state and federal law. At the federal level, marijuana is a Schedule I controlled substance under the U.S. Controlled Substances Act of 1970, which means that there's no currently accepted medical use and there's a high potential for abuse. So at the same time, you have 33 states that have legalized marijuana for medicinal purposes, and another 18 states have legalized marijuana for recreational use. And this number keeps changing on a daily basis. I know that New Mexico just approved the other day, so those numbers may not be correct, but they're awfully close. At the federal level, the Department of Justice during the Obama administration issued the so-called Cole memo that gave federal prosecutors discretion not to prosecute against state law compliant cannabis companies in states that were regulating cannabis. While the memo was later rescinded by Attorney General Sessions, no federal enforcement actions have been taken against companies operating legally at the state level, but whose activities are not legal at the federal level. Separate and apart from this, the Agricultural Improvement Act of 2008, or the Farm Bill, 2018, I think, removed hemp and its extracts from the Controlled Substances Act so long as hemp does not contain more than 0.3% of THC, which is the compound in marijuana that's most commonly associated with a person getting a high. As a result, subject to certain restrictions, hemp can be cultivated legally, and hemp-derived products can also be sold legally across state lines. So when we speak about cannabis companies, there are really two different categories. Those like hemp that are legal at both the federal and the state level, and those whose activities are legal at the state level only in the states where marijuana is legal, but whose activities are not legal at the federal level. So when registered funds look to get exposure to cannabis, historically that has meant investing in Canadian companies where the activities are legal, or in U.S. companies whose activities fall under the scope of the Farm Bill. However, with the Division of Corporation Finance at the SEC, there are a number of registration statements for so-called plant-touching companies that have been brought effective in recent years, and those activities that they conduct are not legal at the federal level. However, the registration statements have been declared effective. NASDAQ and New York Stock Exchange are generally not listed companies whose activities are not legal at the federal level. So shares of those companies would be either over the counter, quoted over the counter on the bulletin board, or on Canadian exchanges or in other locations, but not the major national securities exchanges. Still available for retail investors, but they don't have the same sort of liquidity and cachet, so to speak, that NYSE and NASDAQ companies have. Until recently, the lone exception to this, arguably, and I guess you could, was Innovative Industrial Properties Inc., which is a real estate investment trust that, when it was first listed on the NYSE in 2016, invested only in specialized industrial properties leased to experienced state licensed operators for their regulated medical use cannabis facilities. Since then, IIPR has expanded its focus to no longer require the property be used for medicinal purposes, but also it doesn't have that qualifier anymore. So the operators of the facilities don't necessarily have to be using it for medicinal purposes. So Aaron, you primarily cover real estate companies for JMP Securities, and one of the companies you cover is IIPR. So can you tell us a little bit about IIPR, some of the challenges they face, how investors view the cannabis focus, whether that has changed since IIP first launched with a slight expansion of its mandate? And in other words, is there an increased comfort level with IIPR today in 2021? Has the investor base changed, and anything else you want to talk about IIPR? Oh, Aaron, you're on mute.
Thanks, Owen. Appreciate you having me on the webinar today. Nice overview there. Can you hear me? That's weird. I can't hear you now. I hope you can hear me.
I can. I muted myself. You're on now.
Great. And just so everyone knows, I'm the head of research of real estate at JMP Securities. Been with the firm for 11 years. And I cover a number of REIT industries, but also cover home builders, land developers. So pretty big array of real estate subsectors. Cannabis being one of the most interesting ones over the last couple of years. And as Owen said, I cover innovative industrial properties. Obviously, this is a company that invests in cannabis real estate, and they do it primarily through the sale leaseback model. They can be buying cultivation facilities, or it could be facilities for companies that are vertically integrated and have a number of different aspects of their business that are working through that cannabis vertical. I think that Owen hit on probably the most important point there, and that this company, Innovative Industrial Properties, they've essentially been operating as the only U.S. listed cannabis REIT for the last 5 years. And obviously, they've undergone some dramatic changes since they went public. I mean, let's just step back. That happened in December 2016. They raised just over $60 million of equity, $20 per share. Didn't own any assets at the time. Acquired their first property later that month. Fast forward to today, this company's raised over $2 billion of capital. They own over 70 properties. Market cap's over $4.5 billion. Stock yesterday was at $190 a share. You add in those dividends that they paid out since they went public, along with that share price, you're looking at over 1,000% return since they went public. And these are returns you just don't really see in the REIT world. Let's put that into perspective. The peer set over the same time frame is averaged as 80% return. And you divide by the number of years you're taking that by to get an annualized number. But I mean, just staggering return profile over that time frame. And so you have to ask yourself a logical question: why and how did this happen? And Owen briefly touched on it again. And it's really because there was an extremely limited option for cannabis companies to access capital during a time where you're in a big time growth phase, as its industry is just getting started and actually isn't even legal in certain aspects in certain places. And so you really have this mismatch of supply and demand of capital, kind of a dysfunctional capital market for cannabis. And you look at IIPR, they're putting money to work at cap rates between 11 and 15%. And in the early days of the company, you could make an argument, because cannabis was so young, that there was a risk adjustment going on. There was limited operating history for the operators. The cash flows were inconsistent. No one really knew what was going to happen, and you could justify an 11 to 15% cap rate. But over the last 2 to 3 years, we saw cash flows for the best cannabis operators begin to mature. public markets realizing that these are real businesses that are sustainable. The risk premium for IIPR's cannabis real estate clearly needed to be reduced. And you asked about investor comfort. When you think about that risk premium being reduced, it's clear that the public markets are more comfortable with cannabis real estate today. And that's why we see IIPR trading, below a 5% cap rate if you value their stock, on par with many other commercial real estate asset classes, if not better. And in terms of challenges going forward, that mismatch is going to be the challenge, because they've been putting money to work at 11 to 15%, stocks at sub 5% cap rate now. That type of spread, if it existed forever, you have this value creation scenario that would create kind of infinite returns if you just kept raising money and putting it to work, and that doesn't really play out long term forever. It has to slow down because people will just keep raising capital and competitors will keep coming into the space. So I think their biggest challenge over the next 3 to 5 years will be how much spread there is between the cap rates in the asset class, or what the market values them at, and what they're actually able to invest in the private markets.
Thanks. And there's been a huge shift from 2016 to today in just the number of states where where cannabis has been legalized. So I'm sure that that's opened up additional opportunities for them. They would, and that assuming that continues, and I guess that's a big assumption, but assuming that continues, that would potentially open up some additional opportunities. But it's still it's an interesting. You compare this to other REITs, there's just no comparison. It's almost
that's a good point, Owen. Like, you have these conflicting dynamics where you're gonna see this industry continue to grow. You're seeing more states opening up, whether it's medicinal or whether it's recreational, and that means you need more capital flowing in to fund these cultivation facilities, to fund the stores and the dispensaries. At the same time, I think the expectation is that you're going to have more and more companies coming into the space to try to compete from that capital perspective. So the question becomes, is the growth outpacing the money coming in, and what does that mean for the return profile, and how much value can you extract during that growth period?
So moving a little bit, recently there's been as you mentioned, IIPR basically has had a monopoly in the equity REIT area for since its inception. More recently, though, AFC Gamma, it's a mortgage REIT, went effective, I guess, maybe 3 weeks ago, a couple weeks ago, and it is also involved in the cannabis space, but in a different way. It primarily makes loans to middle market companies that are involved in cannabis operations, and because those loans are fully secured by real estate, they can qualify as a REIT. Another company that you're going to, I guess, just started covering. What sort of additional challenges? So it's a little bit different asset class, but as far as how do they compare to other mortgage REITs, and what additional what additional things do you have to do when you're looking at a company like that as opposed to other mortgage REITs?
No, it's good timing because I initiated coverage on the company yesterday, and I don't cover the mortgage REIT space. We have another analyst that does that, and we work together on AFC Gamma, and I'm the lead there. But I do like to compare them to a degree to IIPR because they are the new public competitor to provide capital to the cannabis space. That's a big deal that you can access the public capital markets, because if you look at the other competitors out there that are providing money, you have some companies that have done JVs, you have some US listed operators, you have friends and family money, you have some semi-institutional money from very wealthy people, but just there's not a ton of options for cannabis operators that are looking to grow. And it's interesting, we talked about this mismatch of capital that's been going on for IIPR. And the model being for AFC Gamma, they're going to loan money typically for around 5 years. And they're doing that versus IIPR at permanent sale leaseback. And the return profile on the loans is actually looking bigger than the cap rate. And that's typically not how it plays out. Typically for commercial real estate, you're going to see the debt is cheaper than the cap rate. And so in this scenario, AFC, their average return on their loan book right now is north of 20%. So compare that to that 11 to 15% cap rate that I talked about for IIPR. That's a pretty dynamic difference. And, you know, normally if you think multifamily, they could borrow in the 3s and they're buying at a 5 cap or something like that. So there's a reason that this is happening. And it gets back to this dysfunction in the cannabis capital market that I was talking about. And really, cannabis operators are starting to recognize that within a relatively short time frame, there's probably going to be cap rate compression on their assets. And so there is a motivation for certain cannabis operators who want to bet that that event is going to occur. They're saying, why would I sell my real estate today at 11 to 15% cap rate when I can take a loan from someone like AFC Gamma? Maybe it's higher cost, maybe 20%, maybe less than that. But in 5 years, when the cap rate on my property goes down to 5, 6, 7, we don't know what it'll end up being. But when it goes down, there's a significant amount of value to be extracted at that point in time, as opposed to selling it today and not being able to capture that. So that's the interesting dynamic going on with AFC. The same issue that I talked about with new competition coming into the space. Will the regulatory environment, legislative environment change? What will that mean for the yield profile? How quickly will that happen, despite the fact that we know that the industry is going to be growing? Those are the issues that are facing them as well. It's very similar, but in a different model. And it'll be interesting to see who becomes the capital provider of choice for the industry over the next couple of years, given that cap rate dynamic that I was talking about.
Thanks. That's interesting. There, you know, one of the things that AFC Gamma is going to have to deal with is that, you know, in order to maintain its requalification, the loans need to be secured by real estate. They have to invest in real estate related assets. So if things like the second lien loans or subordinated loans wouldn't qualify, and it's an interesting structure, and it kind of leads me to, you know, the next part of the discussion, which is you could easily take AFC Gamma and you could put that in an investment company wrapper. You look at the assets that it has, and you know, those are loans to middle market companies, which is you know, something that a BDC could do, or that other registered investment companies could do. This highlights the SEC, how you have different sides of the building who are, you know, handling cannabis in very different ways. The Division of Corporation Finance reviews registration statements filed by REITs, and they've taken the approach that it's really more disclosure, and some of this is based on the statute, so it's not specifically a policy discussion, but they've taken the view that it's really more disclosure oriented, and that in companies that have a cannabis focus, their registration statements can be declared effective. Investment management, on the other hand, and they're the ones who regulate registered funds, whether they be mutual funds, ETFs, closed-end funds, BDCs. They've taken the approach that it's not appropriate for a registered fund to invest in so-called plant-touching companies, and part of that is the concern that investors or shareholders of the funds would would somehow be exposed to some sort of liability as a result of investing in these funds. So the approach that they've taken, and I'll go into this a little bit, is they've required legal opinions to be filed in connection with the registration statements that the funds file. There are a handful of cannabis specific ETFs and mutual funds that have had their registration statements declared effective. They sell shares that are, in the case of ETFs, are listed, but the way that they were able to go effective was to provide a legal opinion. Incidentally, I think it's interesting that this requirement has come solely through the comment process, and the way that this works in investment management, for if it's a new fund of an existing trust, oftentimes the comments aren't even in written form. So I don't think that there's even a written comment out there outside of counsel transcribing what they're being told over the phone that really describes the legal opinion requirement. But having said that, what the opinions say are that neither the fund nor an investment in the fund by shareholders violates the Controlled Substances Act, the Money Laundering Act, or the Drug Paraphernalia Law. And the way that the counsel is able to provide the opinion is twofold. The first is the advisor provides a list of companies that the fund intends to invest in, and then they assess the activities of the companies that are on that list, and whether or not they would potentially be engaged in activities that are not legal at the federal level. And then the second part that they focus on a lot is that the securities that the fund will acquire are only traded on a specific list of exchanges. And so, these securities are only on NASDAQ, NYSE, and a handful of other exchanges, all of which have rules that require that the issuers comply with all laws, rules, and regulations. So, as an example, the over-the-counter bulletin board would not be on that list, and that's where you see a lot of the U.S. issuers that have a plant-touching focus. And then I guess the Canadian Securities Exchange maybe has looser exchange, has looser listing requirements than some of the other Canadian exchanges. But to the extent that the companies have their securities listed on the other exchanges that are listed in the opinion, then it's determined that those companies are compliant with federal law and state law, and therefore it's okay to invest in those. Incidentally, that covers IIPR, that covers AFC Gamma. So it's an interesting question to ask whether whether that's really the best way to go about doing this. But that's the way that these opinions are structured. And the staff has indicated that these opinions should be updated annually. And I think it goes without saying that many law firms are not willing to provide opinions like this, and the ones that do are going to charge a lot of money to do it. So it is a significant cost. It's not a minor expense, and you can question whether what level of comfort do shareholders get from having these opinions. I think it's an open question, but the most recent or one change that's happened. So there are a number of those opinions that all follow that format. More recently, there's at least one opinion that's been filed for an ETF that invests in total return swaps that takes this a step further. So the total return swaps are structured so that the fund identifies a specific company, and these companies are going to be cannabis plant-touching companies that they're not able to invest in directly, or else they violate the opinion. And they have an arrangement with a counterparty where the fund pays the counterparty a fee to set up the total return swap, and then it's obligated to cover any sort of depreciation in the value of the position. The counterparty is obligated to make cash payments to cover any appreciation in the value of the securities. And so then the cash goes back and forth on a daily basis to cover the, to cover wherever the stock goes, or wherever the value of the stock goes. The opinions basically say that since there's no ownership of the securities, there's no you're getting exposure, but there's no ownership, and because there's no ownership, therefore this is not illegal under the Controlled Substances Act, and they the opinions draw analogies to certain kinds of insurance policies, and also views that the SEC has taken with respect to how total return swaps operate and who the owners are, and what and other features of that. So the opinions basically allow a fund to invest in a plant touching company, or no, I'm sorry, not invest in, but get exposure to a plant touching company without investing in it. The benefit is that in the financial statements, they'll list those companies. And so from an investor standpoint, you look at the financial statements, the scheduled investments, and you say they're investing in this, or it certainly looks like they are. So they get all the benefits to it, but they don't have any ownership in it. And the SEC has accepted this as being consistent with the legal opinion requirement. So it's an interesting twist. Certainly form over substance. I don't think there's any question about that. The opinion is at the should level. It's not unqualified. There's really no precedent that anyone can point to. There's nothing directly on point here. So it's an interesting turn, and that's where things stand in investment management. Incidentally, if a fund does not have cannabis as a primary investment strategy, or doesn't have cannabis in its name, they'll never get the comment from the SEC to provide an opinion like this. And there are funds out there that have invested in plant touching companies that don't have a cannabis, but the funds themselves don't have a cannabis focus, so they're not violating any legal opinion. So ironically, the only funds that do hold directly securities of these companies are the ones that don't have to provide the opinions in the first place. So I think it's at an interesting place, because there's been so much movement at the state level, and with the exchanges. I think that at some point in time, the Division of Investment Management will have to modify where it is, but that's the lay of the land right now. And I think subject to change, just like everything else in this space. Things are moving incredibly fast, so this is bound to evolve, probably in the near future. So with that, Christina, are there any questions from the audience?
There's a question from Mike Williams. It's, is IIPR the only pure play marijuana / plant touching company that you know of that is listed on NYSE or NASDAQ? If so, what's their secret? If not, are there certain requirements for public companies to be listed or not be delisted if they expand into the cannabis industry, whether ancillary business or directly?
I'll start, and then Aaron, if you want to chime in. Yes, I think it's it's not. I guess it's maybe not a pure play plant touching company. It's, to some extent it is, but some of the properties that they own are legal under federal law or medicinal. So I guess it depends where you draw that line. But I think there was at least one other REIT that tried to list after IIPR, and the New York Stock Exchange rejected the application. I think it was anecdotally from what I've heard, IIPR sought to list at the right time when there was thought that there was going to be an expansion in just the not legality of cannabis at the federal level, but that there was going to be I think it was the timing was right, put it that way. And I think that has changed a little bit. Although with AFC Gamma going public recently as a mortgage REIT, it's hard to say. I don't know that means that they're open for business. that the exchanges are open for business, but I think that they have more of an open mind than they did before.
Yeah, I think the timing was right for IIPR. If you just look back at when it occurred, it was between the Obama and Trump administration. I think there was somewhat of an expectation for a continued movement towards legalization, and when the Republicans were in control of Congress or were able to block things, it kind of shut down what the exchanges were thinking about doing to a degree. And IIPR was in an advantageous position to capitalize on the fact that they had gotten public. And AFC Gamma, a little bit different, like Owen said, mortgage REIT, but they have dynamics in place with their manager where if there would ever be a default or whatnot, they never actually take physical possession of the properties. They work it through another entity. So technically they never touch the plant, and that was a big deal with them being able to get their listing. And so, you know, maybe that avenue is used more and more for more entities to get public, but I don't think that the plant touching issue has stopped being a hot topic in terms of getting approval from the different regulatory bodies and exchanges.
Yeah, and to just build on that a little bit, the disclosures that are cited on NYSE and NASDAQ websites about the fact that their issuers have to comply with law, that hasn't changed. That's still there. So I think they would say there hasn't been a change in their in the listing requirements. It's you know, there are certain specific facts with respect to these issuers. Any other questions, or I guess we're kind of out of time. So let me that concludes today's chat. If there are any other comments, go ahead and enter it into the Q&A box, and we can always try to address those separately outside of the webinar today. So thank you everybody for joining today. Our next coffee chat will be next Wednesday, April 21st. My colleagues Ed Redder and Ryan Wheeler, will be discussing the 5-part investment advice test. To register for future coffee chat discussions, visit the events page on the Thompson Hine website. And to view any past coffee chat recordings, you can visit the Thompson Hine YouTube channel or go to the investment management page on our website, and we list all the webinars there as well. Thank you for all your interest in attending today's program, and a special thank you to Aaron for sharing his insight. When the webinar ends, you'll be prompted to take a survey providing feedback. This feedback is very important to us and helps us continue to tailor our programs to your needs. Thanks again, and enjoy the rest of your day, and everybody stay well. Thank you.
Thanks, Owen.
Thanks, Aaron.